So we got weak August jobs data in both Canada and the US. What will this mean for a potential rate cut later this month? Let's find out from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Great to see you. Start off with the Fed, if you would. This presumably strengthens the case that there will be a cut September 17th.
Yeah, I think you verbalized it correctly. It cements a cut for September 17th. We got inflation coming before that, but it doesn't matter from a cut perspective. You know, at Jackson Hole, you heard Powell already allude to growth and more employment than CPI. So I think it cements a cut. It's 100% discounted in the market. I think the next big question is how many cuts can we foresee? Right now, the market in the U.S. is forecasting 2.5 cuts, which is in between 50 and 75 basis points. We foresee 75 basis points of cuts this year for the balance of this year in the U.S. because they have a window to get them in. You know, not all is bad in the U.S. There's a lot of stimulative. The big beautiful bill takes effect 2026. There's more certainty. We expect to see employment stabilize in the U.S. So I think they have a window to cut rates here, and they will take advantage of that.
Maybe we can have a quick look at U.S. bond yields because naturally we did see investors inclined to buy bonds today because these numbers point to a lower inflationary environment, all other things being equal,
yes,
as the economists say. But you are wary of long bonds right now.
Yes.
Why is that? You do see inflation coming?
Yes, and you do see that in the rally today. If you look at bond yields, you see the 10-year bond has rallied, call it 11 basis points since the number, and the 30-year bond has rallied 6. So why is that? That's because the more you ease, the more inflation you have within 30 years. It's less control, it's more stimulative, and that's what the market wants a risk premium for. So that's why we're wary of owning longer dated bonds. We'd rather own the 2 to 5 year sector of the bond curve.
Because, I mean, obviously, and with new leadership at the Fed, the question will be how resolute will it be in fighting inflation? Yeah,
and more directly, that 2 to 5 year sector is more directly impacted by Fed eases or Bank of Canada eases for that matter. The 10 to 30 year sector is impacted slightly by that, but more so by your fiscal, by your deficits, by inflation, by your dollar. So there's a lot more influences on the longer part of the curve. So we like being directly related to what monetary policy is going to do. And that's a 2 to 5 year sector.
It is interesting. The long bond yields, really, it's the bond vigilantes and international investors who dictate what they'll be.
Well, I think you brought up another interesting point globally, because it's not just Canada, it's not just U.S. There's a lot of concern around fiscal discipline. You see it in France. We've heard the headlines there. UK now headlines, Japan. So there's a lot of global pressure on longer dated rates, which is, again, why it reinforces to us to focus on that 2 to 5 year sector of the bond market.
What about your Canada strategy? Would you be? Do you think this increases our big job loss and our rising unemployment? Do you think the Bank of Canada will be compelled to go again, cut again?
Yeah, yes, we do. And this is what's interesting with the market. The market's not 100% that the Bank of Canada will ease at September 17th. It's 80%, so very high. But the reason why it's not 100% is the Bank of Canada only has one focus: inflation. U.S. has two focuses, inflation and growth. We don't have that in our mandate. And because core inflation is very sticky at 3%, which is the higher end of the range, the market's still looking to see the next CPI report to get that 100% certainty. We feel a bit different. We feel that because of what's going on unemployment, because of what's going on growth we're seeing in numbers, that we feel the Bank of Canada will not only ease by 25 this one, but match the Fed in 75 basis points of eases in Canada this year and get down to 2% by the end of the year.
2% core rate.
Yeah, core overnight rates, yes, in Canada.
Right. In America, just to return to that for a second, the rates are not stimulative yet. They're still relatively high, I've heard people say anyway.
Yeah, there's arguments. So yes, they're not stimulative, that is for sure. There's arguments of whether they're neutral or restrictive. Okay. Now you're hearing more verbiage about them being restrictive because they still 4.5 or between 4.5, 4.25, but the economy's still doing all right. That's why people are saying maybe it's a neutral rate, but they're arguably restrictive right now, and they do have room to ease further in U.S.
What about Canada? Have we got to the point where our rates are trying to stimulate the economy?
Canada is very complicated, and the reason why it's complicated is The big thing holding back Canada right now is uncertainty. It's not necessarily interest rates. And because there's so much uncertainty in regards to the tariffs and the agreement with the U.S., businesses don't want to invest. Companies don't want to hire. So whether it's stimulative or not is, I think, the second discussion. I think they could ease more, but the big impact is going to come from certainty. We need to see that certainty between Canada and the U.S. to get things going here. So
we've definitely seen a drop-off in corporate capex, for example, because of this tariff to and fro.
Well, you're seeing two things. You're definitely seeing the drop-off in capex. You're hearing about potential EV companies not coming here anymore. You're not hearing about the big private sector investment plans. You're hearing about it public sector, which is the right thing to do. We have to do that. But you're also getting confirmation with the employment number and the unemployment rate going to 7.3. That's a big jump. Going above 7 is big with net job losses. So there's a lot of things here in Canada that says, in our view, that you do need that 75 basis points of eases this year.
Earl, thank you very much indeed.
You're welcome.
Earl Davis joining us today, Head of Fixed Income and Money Markets at BMO Global Asset Management.